Hey everybody, welcome to our second Trader User Group monthly recap. This is for the trading markets December 2014 as we round out the year 2014. I say it's our second one. Actually, we've been doing these every month since 2008, but we've been doing them with an on-site meeting rather than via the internet. But I've got a lot of members in our group. We've doubled our membership almost every year, probably even faster than that. We've got a lot of folks that can't participate just because you're in Europe, Asia Pacific, Latin American markets, or just down under Australia, New Zealand. So we got a lot of folks. So I thought doing it on the webinar makes a lot more sense for everybody. These things are recorded. They're put into our blog. So if you happen to be dialing in and seeing this on YouTube or the blog and you didn't attend the live session, then make sure you come out and register on our site so that you can get in the list. Also, just another little quick admin note. For our members, we will pick up our next session on Tuesday, and then I'll go into the holiday schedule here in just 1 second. But if you are a non-member of our group, I highly encourage you to check us out. We've been doing very well. We've had a pretty good year this year. And I think next year's not going to be any different, actually. And, you know, the markets have had a really interesting turn of it or go of it here in the last 6 weeks. I'll show you the charts here in a minute, but come on out, check out our site, and there are a number of different options for you as far as becoming a member. If you have any questions, then by all means just click on the Contact Us button and send a message in, and I'll be more than happy to respond to you. All right, so let's go take a look at everything here. Before we do that, just a couple of quick particulars I've got to get out of the way. Trading securities can involve high risk and loss of any potential funds invested. Any investment information provided by a user group may not be appropriate for all investors, provided without respect to individual investor financial sophistication, situation, time horizon, or risk tolerance. Therefore, any of the information techniques presented by our user group is intended to be for educational purpose only. It's not intended to be a recommendation to buy or sell any specific security, no matter what your rat brain is going to want you to do. All right, so what I like to do on these monthly sessions, I do these every week also for our members on Sunday night. Our members, for our members that are attending on this session, we're not going to be doing our Sunday night session in lieu of this monthly session. These monthly sessions, by the way, folks, happen on the Saturday after the third Friday of every month. So those of you that are heavy options traders, you'll be familiar with the date. But it should be easy to remember. Let's take a look at the holiday schedule first, and then we'll go into everything. We've got, as you know, we've got Christmas and New Year's coming up. So we're going to have a number of shutdowns during the market. This is one of the slowest days of the year for the markets. If you're in Forex, you can see here the markets are closed on the 24th, and then they open up 5 p.m. on the 25th. And New Year's, the same. You can see the markets closed at 5 p.m. on the 31st and then open back up 5 p.m. on January 1st. For those equity traders out there, Christmas, the market closes 1 p.m. the day before, and then they open again on the 26th, normal time. They're closed all day on the 25th. And then, of course, New Year's, we've got, you know, the same thing. Markets closed on the 1st, markets open back up on the 2nd. So it's going to be a very quiet week all in all, I think. Volume is very low, and I'll talk a little bit about just kind of where I think the market's going to go short term. Also, this coming week, we got a couple of things that can move the markets around, and you think we've been moving around a little bit, but it can get a little bit more dicey or a little bit more fun, depending on whether you're long or short your positions. Tuesday, we've got the GDP coming out of both the United States and Great Britain. Great Britain's coming out at 4:30 in the morning, New York City time. For those of you guys in Europe right now, especially some from London, you know, I'm anxious to jump along the British pound. Not yet. Timing's not there yet, but I think the British pound is going to give us some really good fun in 2015. Durable goods here in the U.S. at 8:30, and the GDP coming out. It's not the finalized print. I'm sorry, it is. It's the finalized print for Q3. As you guys know, the finalized print, the official print, is the third month after the end of the quarter. The other 2 months are just adjustments to the Q3. So we're going to get the GDP number for Q3. So that's a little bit about what we got there. And then Thursday, Christmas Day, not much. In the evening, CPI numbers out of Japan. Okay, hopefully Shinzo Abe is able to stoke some inflation there, but he's certainly not afraid and bashful of putting money into the economy. And those have been some great trades for those of us that have been following along. So that's a little bit about the international side of things. I talked about some of this last week for our members, but let me just kind of show it for you guys here as well. I saw this chart. I thought it was very interesting. You can see over the last 50 years, 5 decades, the returns in each month, just on average. And you can see that December, the one at the bottom, highlighted in bold, is almost the strongest, with the exception of April. December is the strongest month for returns. And it's been a net positive 74% of the time. So December has been, you know, traditionally a very, very strong month. And you could probably rattle off a number of reasons why end of year, whether it's portfolio adjustments, hedge funds moving in and out of various things, taking profits, or mutual funds moving and rebalancing their portfolios, or end of year tax selling for tax purposes, those kind of things. But it tends to be a very strong time. But it's not just the month of December. Here, this thing I think will catch your eye and make it a little bit more interesting for you guys. You can see, and if I draw a line right down the center of this chart right here like this, you can see right here is the first 2 weeks of December, roughly. And then here are the last 3 weeks, roughly, of December, okay? And you can see right here that the first 2 weeks, really, we're below the zero line, okay, as far as the percentage return. You can see that all the money in December, and again, this is averaged over the last 50 years or 5 decades, the last 50 years, really starting around the 16th of December, the markets in the month of December, that's where December has made all of its money. So you could say that, you know, up in this area right up there, right a little bit over 1.4%, just the last couple of weeks in December. And because it's very light trading volume, the prices tend to get pushed around a little bit. And certainly, you know, the way the markets have moved over the past couple of weeks, you could probably say this makes a lot of sense, because, you know, we certainly in the first 2 weeks of December really didn't do very well, but it looks like we're off to a very robust ending to December according to history and statistics. Okay, so I thought I'd just kind of pop this out there for you guys. But there are a couple of underlying problems that I see in the market. And I'm not an alarmist. For those of you that are members, you know I'm not an alarmist. We take whatever the market gives us. We're agnostic. We don't really care. Our bottom line is we want to make money. But I do see some things on the chart that concern me a little bit, and we're going to go into these in a minute. Let's look at sector rotation. Sector rotation, as you guys know, is a favorite of ours, and me especially. I love looking where the money is going into and out of. Remember, we're retail traders. We're not moving tens of billions of dollars or hundreds of billions of dollars. We're just not doing that. So what we tend to do is, and sometimes markets just tend to move and they have a life of their own, but there's sector rotation going on all the time. This sector rotation chart, just to kind of show you how it works. You know, you've got the market tends to go in this kind of pattern. It tends to, well, let's do it back up. It tends to go in that kind of cyclical pattern like that. And right in the center here is the SPX. This is a rotation chart with the SPX as the benchmark index. So it's really a relative basis chart, meaning everything on this chart is in relation to the performance of the SPX. So you could have something showing very strong on this chart, yet during that time frame the stock or index has moved down. It just moved down less than the SPX. So what we're doing with these charts is identifying where's money going and where is it coming from and where is it going to. And this is kind of how we like to put money to play, okay? So every one of these charts I'm going to show you is measured against the SPX. Why? Because that's how every mutual fund company, people that work for mutual funds, hedge funds, that's how they all get paid. And how they get paid is what motivates them, and what motivates them is outperforming the SPX, and the way to do that is they move money. We don't really care. The end result is we want to follow the money, okay? You can see that the further away you go to the upper right, that is the strongest outperformance of the SPX. Now, this is over the past 90 days, 3 months roughly. Last quarter is probably the best way to phrase it. And you can see here that utilities is leading the way, which, you know, we've had these instances before, and this is what happens when you get the federal government involved in everything. It really is a mess. But you've got so much money sloshing around that utilities is a risk-off environment. It tends to lead the way when you've got very low interest rates. It tends to lead the way when you've got fear in the market. So we've got that there, yet we're close to all-time highs in a lot of the indices. So there's a little bit of a dichotomy there, okay? You can naturally see down at the other end of the spectrum is energy, down in the red, down the lower left-hand quadrant down there, okay? Very, very weak. And speaking of these quadrants, the area that we like to invest in, this is a very good quadrant right here. Why? Because things flow in a clockwise fashion. Generally, they go from an improving sector to a leading sector in the green, okay? And a weakening sector is money. Generally, in this sector down here, you've got profit taking, right? Money's coming out of that sector. And then, of course, down here, the money is already out, and they're moving into other sectors. Generally, they're moving into sectors up here, or they're moving into sectors over here in the leading side. Again, at the end of the day, we don't care. We want to follow the money. So you can see this sector rotation. We've got staples up here. Staples is another sector that is a risk-off kind of sector. You'll see some of these like discretionary. They've been just almost, if they're near the center bullseye of this chart, that means they've been performing in line with the SPX, almost correlated perfectly, which is not good. We've got technology slightly underperforming the SPX. And you can see once they get in this quadrant here, outperforming, they don't stay here very long. The tail starts moving down, and then they get into this sector down here. And what that means is profits are being slowly taken out of these investments, and they're typically put investments over here in this sector right here, which drives these more towards the right side. So that's why you've got this cyclical rotational, clockwise rotational basis in these sectors. Now, I've said with XLE down here, I said the next best, the most natural movement for XLE is going to be up. And sure enough, that's what we've got over the past 2 weeks. I'll show you that in a minute here. So, the past 2 weeks, here are the sectors, a completely different view. Here is XLE, okay? It was down, way down in the southern part down here, and it's just done very well right now. I mean, it's moved up very strong, and it's looking good right now. I say looking good on a relative basis and for a near term. I think we're going to get a kind of a counter-cyclical move up, and then a little bit of a go, no-go line. I'll show you the charts here in a minute. But this one, and generally when you get stocks way, well, let's get it back up. Generally when you get stocks down in the bottom down here, it's great to play a counter-cyclical move. But that's over the past 2 weeks. That's what's been driving. But look at utilities, still up at the top. That concerns me. You can see these green tails here. Each little circle represents 1 day, okay? And it's measured against the SPX. So each distance between the circle. And you can see like healthcare, which has been doing very well, has slowly been coming out. Profits are slowly being taken out. You can see financials kind of turning down. It's that teardrop shape. profits coming out. Staples, it's kind of moved just right into the upper right quadrant. Like Staples is like utilities. It's a risk-off kind of play. Okay, discretionary profits coming out. You can see now it's moving down to this weakening sector right here. And then, of course, we got materials, and we've got technology and the others down there. So really, I'm seeing over here energy, it's just a bounce, right? Almost like a dead cat bounce because oil has just been flatlining. But you can see over here, we've got utilities and we got staples in this area. The others, although they're in here, they're kind of turning down a little bit. So net, we've got utilities, XLU. We've got staples, XLP. And we do have financials, XLF. Now, these guys right here, I do like. XLU and XLP are a risk-off environment. Should we get a pop, like I'm thinking we're going to get through the end of the year into January, and then the markets roll, money is flowing into these guys right here. All right, and that would be a place to park some money. XLF is moving up in the financials because they're anticipating higher interest rates. Now, I do believe that utilities, there could be some interesting trade plays on this one, which I'll show you here in a minute when we go into the chart. Okay, but that's kind of the ones that I see right now. And then the question is, what about this guy right here, healthcare, XLV? Well, healthcare is done very, very well. You can see it. It is right down there right now. It's still, it's kind of officially gotten into this quadrant right there. So money is coming out. But I do believe healthcare, particularly the technology, biotechnology side, XBI is kind of the ETF that tracks the biotechs, I think is still going to have a strong year next year as well. All right. So when risk comes back into the marketplace, this is a good place to be, XBI, which is a biotech sector. XLV, I don't have any problem with healthcare and XLV, all right? But right now, if we get that pullback, XLU and XLP are going to be sectors where, as well as maybe some in XLF, all right? So that's just a little bit about this. Now, why don't we just go in and take a look at these sectors real quick individually. First thing up is commodities. You guys know that we've made some great plays in commodities. I see Jenny in here. Jenny, she's one of our commodity, she's a farmer. You like to farm. But look, we've got corn, we've got wheat, and we've got soybeans. They're all coming into this area here. You can see the cyclical nature of this. The agricultural market is doing very strong. We played these nicely. You can see also some of the softs right here with cotton and sugar. You can see natural gas, which is one of the energy stocks that is traditionally a bullish play in Q4 until February, and then mid-January to February, money starts coming out of natural gas. But natural gas has been a very tricky one. I think I've had a couple of my members refer to it as the widowmaker because it's up and down, up and down, up and down. Yeah, hey Jenny. But you guys can see the ag market doing very well. But by the same token, meats right here. This is one that I had our members jump into. I jumped into this one. We did very well. Live cattle, we shorted live cattle in the commodities market. Now, some of these have really good ETFs that you can trade. Others do not. With meats, there's cow, C-O-W, and moo, M-O-O, but they don't really track live cattle as closely as the futures. But this one turned out to be a good trade. Got stopped out for great profits. And I'm going to enter it back in because I do believe this one is going to continue down and continue to underperform. Again, this is in relative to the SPX. You can see gold is still underperforming. You can see pigs, lean hogs, they're underperforming. Gold and silver, they're underperforming. Cocoa, which had been strong, is underperforming. Copper, which is a metal. Generally, copper is kind of it is affectionately referred to as Dr. Copper by some of my analyst friends, which kind of tracks the global markets. But you can see the tail on this. Now, this is a 90-day kind of view of how this works. Now, look down below down here. Gasoline and oil, all right? These are two in the lower left that I do believe at some point are going to stabilize and then come back up here. We want to play them, okay? We've played them to the downside, and now we're going to play them to the upside. Money cycles, folks, but you do not want to try and jump in too early to these guys. Gasoline, a good way to play that if you do not want to play the futures is UGA. It's the ETF. It tracks it. Oil, well, obviously XLE is one of them, but it doesn't really track oil. XLE is more of a sector play because it's not just the price of oil. It includes refineries, service providers, oil companies, and a number of different ones. XLE has actually shown some really nice strength lately. The other one that tracks oil more closely is USO, an ETF that tracks that. So you can see in this commodity sector, you know, in the ag is definitely leading the way. Now, what does that typically mean? That means they're probably going to stay strong for a little bit longer before they start to roll back over and profits come out. Let's look at the countries. Understand what's happened from Japan to China to the ECB, the 18 countries that make up the ECB, Great Britain, and the United States. Have you guys heard that song, Money, Money, Money? That's kind of what's going on. And then with the crash in oil, it's really destroyed a couple of countries. In the lower left corner, you can see RSX, which is Russia. It's very volatile. There's a lot of stability issues in Russia right now. The ruble is crashed. And remember, they had that that's what broke up the Soviet Union a decade ago when they defaulted on their loans and then they just broke up. So it's down in the lower left corner. Not surprising that it is just underperformed. But let's look up here. There's Germany, EWG. And you can see down here just barely France, right? And then EZU, which is a combined emerging market kind of play. But the one that I like is Germany, EWG. They've got some good news last week, and there is rumors that and until they do it, to me, it's just a rumor because there's been rumors for 6 months, that Mario Draghi in January is going to come out and announce a huge stimulus program for the ECB, the 18 countries that comprise the ECB. If that's the case, then you're going to see EWG probably move over, and now this is benchmarked against the SPX now. You're going to see EWG continue to outperform. You're going to see EWQ, which is France, and then you're going to see some of the other countries as well. But EWG would be my play in the ECB because that is the strongest country that drives that one right there. EWJ is Japan. They've been fairly weak. Understand the currency. It's not the currency. It's Japan, the index. The Nikkei has been strong, but lately it's been fairly weak, only because generally they kind of go opposite of each other. You'll see Japan go down and the yen go up, and then when the yen rolls over, you'll see EWJ move back up. But Shinzo Abe's got his work cut out for him over there in Japan. China, again, FXI, they're having some issues, so they're down in the red as well. And then down here, Latin American markets, just not doing very well also. So in South Korea. So the only one I really would be interested in playing probably would be Germany. Okay, that would be the one that would be of interest to me. Now, let's break down some of the sectors that I talked about and just see if we can't find something that makes sense over the next month. Transportation, well, yeah, everything in transportation has moved up very nicely because the cost of gasoline and oil is very, very low, right? You can see JB Hunt. JBHT is a really good play. UAL, money's kind of come out of UAL, money's come out of JetBlue, money's come out of Southwest Airlines, Delta Airlines. You can see all of these are pointing in that direction. So I wouldn't chase airlines right now. It looks like some money is rotating out of there and coming into some of the shippers like JB Hunt, C.H. Robinson. You can't see it, but it's right there. I've got UPS. I just cashed out of UPS before the FedEx earnings. You can see FedEx down there. In sympathy, UPS fell. But that's, again, it's in relationship to the SPX at the center there. But I still like transportation, guys, because of the low energy cost, gasoline cost. And then we've got some that are relatively new that have moved in. Kansas City Southern or Railroad. I like that guy. One you guys may not have heard of, but it's a key one that makes up this sector is Kirby, K-E-X. And then this one right here, GMAT, which is GATX Corp. GAX Corp, I guess. So these are ones that I like, all right? And it's one of those that in this sector, as long as we've got cheap gas, then I think these are going to continue to be very strong, okay? And let me just see something here. Yeah, Stan says one aspect of the recently passed spending bill for fiscal 2015 is the elimination of regulations regarding trucking hours. So, oh, that's great, man. We can have these 18-wheelers just blowing right through toll booths. Let them work 24/7. I got my brother-in-law runs a trucking business. The elimination of this regulation, which was implemented by the Department of Transportation a couple of years ago, is probably going to help the economy. But again, that's why J.B. Hunt is up there. I think let me get back to it. I think J.B. Hunt could be good, guys. It's a good trucking company, and I could see money flowing in. So J.B. Hunt, and in fact, it just moved into the leading sector, right? So that may be one you want to put on your watch list. One that you want to do. And yes, Stan's our resident guru in our group. Thanks, Stan. On the transportation side. Now, if we come down and let's take a look at industrials. Over the past couple of weeks, almost everything in industrials is down. Industrials depends a lot on a global nature. You can see Caterpillar down here, very poor. Boeing, they didn't do well in their earnings. You can see GE, Union Pacific, they're starting to move back up. I do believe Union Pacific is going to come back up in this area here. Some of these had a pretty good little sell-off, so I think they're going to be fairly good. CSX, but I do like Union Pacific. You can see 3M has held up very well. UPS has held up well. I took really good profits out of UPS. We were in and out of that a couple of times. I know a lot of our members followed along here. But I do like those. Honeywell is up there. FedEx is not doing as well. They just had really horrible earnings. So, but this is the industrial side here. So it's not as strong as I would like. If you do get into the industrials, which is XLI, right, then you would look at 3M, possibly Honeywell. Those are really the only ones that really kind of stand out for me as far as where money is going. Take a look at energy, guys. This looks like a it looks like I don't know what you would call this, but this just shows you the cyclical nature of how money goes. This is the energy sector over the past 2 weeks. Rig, Halliburton, Apache, Schlumberger, EOG, Hess, PXD. You can see all of these guys, just big, huge bounce. Big, huge bounce. Now, I think they're going to weaken a little bit if oil starts to roll back over. But, you know, this is the classic, you know, buy on the oversold nature. So all of these. Now, out of these, the ones that I like a lot, I like Apache, I like Schlumberger, SLB, I'm sorry, this is Apache right here. APA. I like Schlumberger. I like Apache. Those are two that for me, I really do like a lot. I like EOG. These are Phillips 66. It's typically very strong. It's weak right now, but I like Hess. So these are the guys that I've circled that I like right there. So in the energy sector, when we get this bounce, these guys are going to, as you can see here, they've just moved dramatically. I mean, just huge. Almost every one of them, money just went right into them. Now, what we have to distinguish is this just short-term longs coming in to play a bounce, or is this money getting ready to be parked into energy? I think energy overdid it a little bit on that fast down move, but typically when something moves really hard down, you have a counter trend move, and then you get one of these things, and then it comes down, it takes out the prior pivot low, and then it makes a new low. And then at this point here is when we start to get the consolidation. Right now, we're in this move right there. So for those looking to place money for a longer period of time, I wouldn't do it just yet. Okay, that would be my advice on that. Discretionary, XLY. Again, this is viewed as a risk-on type of trade, meaning the markets are great. I'm going to go out and buy a jet ski or a big screen TV. You can see everything that's in the green is pointing down. There's a lot that have moved. Target has moved down. CVC has moved down. Starbucks has moved down. Expedia, Nike. A lot of retailers have moved down. But the only retailer that's moved up is Coach. But otherwise, everybody is pointing down. So discretionary, Lowe's is another one. Dollar General. The time to really play these sectors was about 4 weeks ago. We were talking about this before as discretionary, comprised of a lot of retailers. And you can see some of the old stalwarts down here, Amazon, McDonald's just really hadn't been doing good. Priceline, Wynn on the gambling side, Yum Brands, just not very good at all. Netflix is the lone holdout on improving. So I'm going to put that out there and just take a look at that and see if it makes sense for an entry. Because generally, when something gets into this quadrant right here, it'll work its way over here before it works its way back down there in a profit-taking mode. So Netflix looks good to me. But otherwise, discretionary, be very careful on that. Financials. You remember I told you financials was one of the ones I liked. Really the only one, Metropolitan is the only one here in ICE. But otherwise, financials have moved very nicely. Prudentials, NASDAQ, Bank of America, KeyCorp, BBT, American Express, Wells Fargo, Goldman Sachs. Zion, this is one that I like. It's a regional bank out on the West Coast. But these are ones that I like, all right? Now remember, Janet Yellen gave us this past week a gift, and it was really one of those rare statements where she said what everybody wanted to hear. The doves heard what they wanted to hear, and the hawks heard what they wanted to hear. What do I mean by that? Well, they changed the language, or she changed, or the board changed the language to considerable time, meaning when they're going to raise interest rates, to we're going to be patient. Now, the hawks read that as, okay, by taking the language considerable time to raise interest rates out of their policy statement, mean they can raise their rates sooner if they want. Because as long as they got that phrase considerable time, it kind of locks them into considerable time. So they took it out. So the hawks liked that. But the doves liked it because Yellen also said, we're going to be patient. You know, these pronouncements really are just, they don't mean beans, other than the analysts follow them very closely, and then money goes based on how they say. So, and I said both sides like the equation. So those that think the interest rates are going to rise sooner, like, oh, you can see money going into the banking sector, because as long as interest rates stay very low, banks don't make a lot of money. That's how they make their money, in the spread between what it costs for them to put money into their account versus what they loan it out at. And banks, the credit, the markets just are still very tight as far as loosening controls and getting money out into the market. But banks have done very well. This guy right here, keep him on your watch list, Zion, Z-I-O-N. But I've talked about these many times. BAC, BBT, Wells Fargo is one of the better run banks out there. So these are banks that we like, and I like the financial side. Technology. Well, you remember technology was not doing so well. And it was pulling out of the leading sector into profit taking. The only one that was holding up fairly well was Oracle and eBay. Those are the only ones that actually moved into the leading sector. And Qualcomm as well. Qualcomm, Oracle, and eBay. The others, again, in relation to the SPX, because just because they're down here in the red doesn't mean they went up, did not go up. They could have gone up over the past couple of weeks or past week or so, but not in relation to the SPX, not as well. But you can see here Qualcomm, eBay, Oracle, and one other point I want to make about this chart, there are a ton of technology stocks out there. These stocks here comprise the bulk of the sector XLK, all right? I could probably put another 50 stocks on here that are mid-cap and small-cap that you could say are technology-related that are very good plays. But I'm just talking about the bigger ones right now, okay? I think in another one of these sessions, I'm going to break it down even more and go into some really strong ones, you know, mid-cap, smaller-cap plays in each of these sectors, because those are the ones that really have the juice. But these, though, are really good for option plays because it takes away some of the equity sine wave effect in your account. CRM is moved up very strong. You can see it was very oversold, and generally anything down in the lower, like energy, moving up is a good thing. But these are really the only ones. eBay is a good one. Oracle is a good one. Qualcomm, again, each one of these circles represents 1 day in time as it relates to the SPX. It's moving down. It's still outperforming the SPX, but it's moving down. So if I had to rate these, I would say eBay and Oracle would be the best that I see right now of the large cap in XLK. Okay. If we take a look at materials, they suck. The only material that makes a lot of sense right now, and it's in the materials area, is Sherwin-Williams, SHW. I would look at that. You can see here it's just steadily been improving, and it's sitting right there, okay? And it may be a good one. And another one that's kind of crept up there in the materials is ECL, Ecolab. So these two guys in the material sector, and when materials as a group, when money starts flowing back into the material sector, that's XLB. These being, and remember, the big money when it flows into the sector and they go, hey, we're going to allocate another 4% of our money to the material sector, they'll then go into the larger companies that make up the material sector and just start buying shares, right? That's how they do it. They're not going to sit there and look at the charts. They're just going to start buying shares. So we focus on the larger shares that make up each of these sectors. So SHW and ECL make sense to me in the material sector. Healthcare has been really good. Healthcare is XLV, all right? It's been a really good sector. You can see Gilead, BIIB, Biogen, done very well. Celgene, you can see, though, that they're all pointing in this direction. All of the curves are going like that. That tells me it's done very well for a while, and money is slowly coming out. You might not be able to see it. Here's the SPX performance right there. They're still outperforming the SPX, most of them. But you can see down in this area there, Pfizer, United Healthcare, Celgene, Eli Lilly, and then down here, Merck, Express Script, ABBV, there are Johnson & Johnson. All of these down here are either performing at or slightly underperforming the SPX. The only ones that are outperforming the SPX, Humana or Biogen or Gilead, they're starting to turn down. So that tells me money's slowly kind of being taken out of XLV right now and going into other sectors, possibly energy, because there's a huge oversold nature there, possibly a couple of others, okay? Because even though they may have 40 billion or 100 billion, there's limited, you know, they got to move money from one sector to another, so we get this rotation. So if you've got And if you've got holdings in any of the sectors, then just set some tighter stops. That's all I would suggest there. If you're not in it right now, I'd give it a little bit of time and let some of these pull back a little bit. All right, that's how I would take a look at that. Consumer staples. Again, Walgreens. We've been in and out of that before several times, made great money. It is doing very well over the past 2 weeks. CVS, Kraft, Procter & Gamble, okay, Colgate Palmolive, Altria Group, tobacco. All of these guys are risk-off types of trades, and yet over the past 2 weeks, they're doing very well, okay? Even with the big bounce up over the past 2 days, you can see they're still doing very well. So money has kind of very quietly moved into the staple side. Again, that just concerns me a little bit. I want to see, ideally, I would like to see this in the staples, in the consumer discretionary sector. I'd like to see this in the technology sector, but we don't see it. So this is one of those kind of things there. So and yeah, Stan says WAG, the ticker symbol WAG for Walgreens is moving to NASDAQ. That's pretty cool. Let's see, what else is Stan giving us here? It will list the Walgreens under WBA, right? Well, that's interesting. Introduced, they're kind of reorganizing Walgreens into a holding company. It's part of the Alliance Boots merger. Okay, great. So I guess you're going to go to WBA. Is that what you're saying, Stan? The new ticker. But I do like Walgreens. I think that one is going to be a really good one. We've traded that one before in our group, and we've done very well with this one. So I would imagine for a while, for the time being, when you type in WAG, you'll get it, but then after a while, it'll just flip over to WBA. So thanks, Stan. But that is Walgreens. That's a good one. Consumer staples, CVS, Kraft. So if you want to pick up some consumer staples as you go through the end of the year into January, I think we're going to be a little bit bullish going to the end of the year, but I'll show you in the charts in just 1 minute why I'm a little bit concerned about it. Okay. Now, utilities, the last one. This, in a rare instance over the past 2 weeks, every single utility is leading, every single major utility is leading the SPX. Unbelievable. We've got Duke, we've got Northeast Utilities, we've got Excel, Northeast Utilities, Duke, we've got Southern Company, PEG. It's just unbelievable what we've got here with the utility sector. I don't like it. Well, from an investment standpoint, yeah, money is flowing in here. You see a few of them starting to turn down, but there are a lot coming in here. PPL. So, folks, I just want to tell you guys again that when money goes hard in the utilities, it's seeking safety. It's looking for dividends. The average dividend yield in the utilities is higher than other sectors because that's kind of where these guys are big capital intensive. So it's seeking safety. And as you can see, it has outperformed the SPX. And again, this is 2 weeks. This is not 90 days. But utilities is leading the way for the past 90 days and for the past 2 weeks. So that just concerns me. So now why don't we go into the charts here. Let me just freeze my screen. And then let me just take a look at one thing here. Bear with me 1 minute. And I'm going to just get the chart or go back over to the screens and we'll start it off here. Just bear with me 1 minute. Let me just move a couple things around here. By the way, this recording will be on our blog, so you'll be able to see it. Let's get the charts up here, and we will get everything going here. So I am going to start off with the SPX, and we're going to start off with the weekly chart, and just kind of take a step back here for a second, just see where the hell everything is. Okay, you should be able to see the SPX right now. Okay, good. Now, let's go through it. What we've got right here is a weekly chart of the SPX. I've got a couple of things on here. I'm going to turn my drawing tool back on here again, just so that I can just kind of draw on these charts just because I like to. Let's see here. Let's get the color picked, and then let's get the tool on. All right. You can see back in this area here, this is 2000, and in this case, it's 2011. And you can see we've honored this channel all the way up, okay? You can see we're right at the top part of the channel, and then we've kind of come down towards the center. If I were to draw a center line there, that's what this drop gave us. And now we're starting to move back up again. But on a weekly chart, remember what I said? I said this in our last monthly session as well. And if you're not a monthly member, I mean, if you're not an annual member of our group or a member, you'll know that one of the things that we absolutely love to trade, because it's a high probability trade, is something called a bearish divergence trade. I've got it on the RSI. That's the indicator right there, but I can also show you here on the stochastics. I can also show you on the MACD and several other indicators that we've got a bearish divergence. And this divergence basically tells us that as we're moving higher, things are just getting a little bit weaker here. Okay, so we've got this chart here, and we're sitting almost at the top of this trend line. And we only penetrated this trend line very early on, but then outside of that, and just a little bit. But basically, we've honored this trend line for several years now. So why don't we just zoom in? I'm going to take us into a daily here and just show you guys a couple of things here that I'm seeing on this chart. Okay. So if we come into the daily, but let's just zoom in a little bit just so I can get you guys a little bit more acclimated here. Okay, let's come out to the daily. Okay, so we're looking at the cash index of the SPX. Here's the trend line or the channel, right? And you can see where we're sitting right here. We had a huge bounce. Okay, let's get the RSI down here below. You can see the RSI down below. I've got the 50 line in yellow dashes highlighted. You can see that represents, you know, are we getting into a bullish mode or a bearish mode? We've gotten into a bullish mode, obviously, with these two huge candles up. Okay, you can see the oscillator there and the stochastics both moving up. You can see the MACD both moving up. And I'm going to stay on the let's stay on the oscillator for just 1 minute. All right. Here's where we're sitting right now on this move. You can see that we regained very comfortably the 50 EMA. And just to kind of acclimate you guys, that's the prior pivot high there at 2079.47 on the SPX cash index. You can see that that would put us right up into this area here, which is where I estimate the odds or the chart favors us going over the next couple of weeks as we go through the end of the year. It favors that kind of move. Not only that, but we got an Elliott wave count of a 3, 4, and then we typically get a 5. But look down here, guys. We had a lot of strength right there in this movement as we moved up. A lot of strength. And then we just did not have much right here. And now we're moving back up again. And if we take out this high right here, and we come through here and we move up higher, we're going to see this kind of pattern here where we've got it like that, setting us up for a very good bearish divergence on the daily. That would give us one on the daily. We've got one on the weekly. And then what that means is we are now getting in a situation where, you know, we could go through the month of January, maybe the first week or so, okay, and then all of a sudden, bam, we get a rollover, okay? So I'm not saying that is what is going to happen, but I'm saying the charts seem to be indicating this is one plausible move. Also, it puts us at the top of that channel again, all right? And if we hit the top of that channel, then that second move gives us a move back down into the center here, or maybe even down to this lower channel within the channel right down here, which would take us right back down to this trend line right there, or that prior pivot low, okay, in that kind of move like that. And if we make this move, then I think we're going to go down even lower through January into February. Now, take a look at what's coming up. We've got the ECB coming up with a potential stimulus in Europe. So that could act as a trigger to take us up and give us a little bit more of a push higher. We may grind a little bit, right? I mean, we may grind and do one of these kind of things like this, and then we get an ECB stimulus. We get one of these kind of things like that, and then we give it up like that. And then we get this little strength into like that, and then it gives us one of these kind of things like that, which gives us a setup there. So this is one scenario that I'm looking at. All right, that is one scenario I'm looking at. And again, being traders and not rat brain traders, what we want to do is, all we can do is play out the odds and probable scenarios, and we take it one bar at a time. In this case, we're on a daily bar. So another scenario is, notice we'll probably take out these highs. We'll probably come up, hit this right here, and then we'll fluctuate a little bit, right? And then we may get another little bump up with the ECB if they do that. Now, another trigger is if the ECB does not do that, that'll give us a harder down move, because I think some of that's starting to be priced into a lot of the European stocks right now. But at the end of the day, we don't really care. We're just going to follow the chart action here. But this is what the charts are telling me. You can see right there is the 50 EMA. We took it out. The 200 EMA is sitting right down in that area there. So we're comfortably ensconced in a slight grind higher or a move higher through the end of the year. And that would also kind of hold well with where we've got with the statistics that I showed you earlier in the day. Okay, in this session. So that's kind of where we're sitting here with the E-minis. If we look at the Russell, now on the Russell, remember, we love to look at the Russell and use that as a comparison of risk on, risk off as it relates to the E-minis and the S&P 500. The Russell has held up very, very well. Money didn't come out of the Russell very much. You can see while the E-minis over the past week or so were really going down, the Russell stayed in this tight pattern right there. You can see this blue dashed line is the opening price of the Russell for 2014. And with the exception of about 3 days, boom, we got right back up, and now we're sitting at the top of this little pattern right there. You can say that this is a flag pattern, and the break favors an upside break, because that was the direction we're moving in as we go into it, all right? And then we had the break to the downside. But then Janet Yellen came out and the government got involved, and then boom, away we go. So, but now the break favors an upside break, possibly testing the highs of 2014 for the Russell of 1213.44. All right, but notice we got the same pattern here. If we come up and move a little bit higher, this gives us a 3-leg, a 4-leg, and then a possible 5-leg up here, and then we're going to set up for another bearish divergence here too. All right, so we're getting this thing starting to tee itself up for a little bit more bullish action, and then a little bit of a roll, or it could be a big roll. The thing that is really good about the beds and the buds, the bullish divergences, is it tells you you're going to get a little bit of a weakness, but it doesn't tell you how much until the price action starts moving. Now, for those of you that are members that were really sticking with us over the past several weeks, I went into excruciating detail on, the environment of the market. Are we in a buy on the dip, or are we a sell on the rally? And we got that played out very well. And I know a lot of you made some good money, or saved some money, or hedged yourself when we went from a buy on the dip to a sell on the rally, sell on the rally kind of mode. And now, right now, we're on a buy on a dip kind of mode again. All right, that will change, I suspect, as we go into January. All right, so that's a little bit about where I'm seeing the markets. If we look at the volatility and we just look at the VIX, it's still elevated, guys. Even with those 2 big strong days, the VIX closed down just 32 ticks, but it's still up there around 16.49. That's still elevated for the VIX. All right. And we're still in this situation here. So don't forget, this thing can bounce very hard, very quick. And for those of you that have larger portfolio sizes, and some of you members out there that I've worked with, the VIX futures is a great hedge, VX, and I know some of you are using it very effectively. But anyway, this is where I see the volatility right now. I think it's going to continue to grind lower until we get to the end of the year, and I think we're going to see another spike up as we go into January. That may happen sooner, but I don't think so. Bonds really was, it really sold off on Yellen, and then it's starting to get a little bit of a bounce here. And you know, bonds, look at this right here, guys. This is bonds for the entire year of 2014. And this is what happens when governments get involved with money and forcing money into the equity market and with stimulus. Now, it just ended, but this was the beginning of 2014. And this is the channel that bonds have been in. Remember, the higher bonds goes, the lower interest rates go. And we came right up to that point here. As you guys know, I was short bonds up in this area, expecting a move down. That's what we got. But now we're starting to get a move back up just a little bit in bonds. This concerns me, but we do have this overall larger BED here, this bed. So I do believe longer term, bonds are going to work their way down. Interest rates are going to work their way up. Now, short term, over the next 3 or 4 weeks, anything can happen. But for you guys that like to play these kind of things, TLT follows bonds. So TLT goes down when bonds goes down, and it goes up when bonds goes up. TBT is just the opposite. TBT follows interest rates. So if you think interest rates are going to go up, then you would play TBT to the upside. There is an interesting thought that says, I'm going to play, I think interest rates are going to be higher 12 months from now than where they are right now. If you believe in that, then you can come out there and hold on to TBT. Now, there are a number of option strategies that you can do that if interest rates come down, it doesn't look so bad on your profit and loss. There's ways to do that. One of our favorite ways is using ratio diagonals. And there are other ways to do that too. You can use you can use collars and a few other things, and you can hedge this. Same thing with TLT to the long side too, or to the downside. So I like because bonds are really stretched right here. Interest rates are really low. I love imbalances, so I can see this thing doing this over the next through next year. I don't think interest rates are going to go much lower than they are now. If we get an implosion and a pullback in the middle of January going into February, we will see interest rates come up a little bit higher and make their final assault before they roll over. So I am slowly taking some profits out of my shorts up in this area up here, but once we get the signal of a rollover, then bonds will move pretty quickly. Okay, so that's a little bit about bonds. Currencies. Currencies are very interesting. Dollar, we're long the dollar. Well, that's not the dollar. Let me get the dollar on here. I hit the wrong one. Here's the dollar right here. You can see on this daily chart, we had that key breakout, right? Here's the key breakout. Now, the only thing that concerns me is we've got this Elliott wave pattern, this 3, 4, 5. And the other thing that concerns me is that helps confirm that, yeah, this is an Elliott wave 3, 4, 5, is that we got that set up right there, which again gives us that divergence, a bearish divergence. We were in this long area right there. I said whichever way it breaks. Remember, we played the dollar long right there. UUP for the ETF or the currency futures or Forex. But we traded it long. We got out there, took some profits. We got in here, and then it settled in here. And I said, if it breaks out, the odds favor a break to the north, then that would be a bullish play. And sure enough, it did. It took out 89.475. It can go a lot higher, but we're getting this bed set up, so it's going to be kind of a grind kind of mode. I would like to see the dollar sell off back down just a little bit more down here, and then start a whole new chapter in its move higher. Longer term, though, we are bullish the dollar, guys. It's just kind of where we want to be right now from a currency perspective. The other one that I'm not bullish now, but I will be, is the British pound. Look at this chart, guys. I mean, it's ugly. The British pound, and let me just kind of adjust it just a little bit so I can get it all on the screen. This is a daily chart of the British pound. Remember, we played the pound bullish in 2013, and then, in 2014, they had a couple things happen. Right up in this area here, they had the Scottish vote, and they voted to stay in the Union, in the UK, but all of a sudden, the UK started faltering because their biggest trading partner, which would be Europe, the rest of Europe or the ECB, is faltering. So the UK fell down, their inflation came back down, and they said, well, we can't raise interest rates now. So the pound just did that. Now we're in this consolidated mode right here, and it's just gathering steam. And in this case, we got what we like to see. We got what I call a bud, a bullish divergence. So that means we got to have one of these kind of long, drawn-out kind of patterns like that. And I think it's going to sit there. It's not going to go too high. It's not going to go too low. But if we get bad news out of the British economy, then notice that we can do one of these head fakes where we come up a little bit and then roll back down and get a final thrust, giving us an Elliott wave 5. All right. So, but we do get a little bit of cross currents here with this bullish divergence. So I'm watching this one. I love the pound to the upside. Just for you guys that don't follow it that closely, right now, the U.S. is the strongest country globally from an economic standpoint with the government data coming out. Then running behind the U.S. is Britain, and then behind Britain is Germany. Okay, so just to kind of give you those independent countries that seem to be doing better than others, it's the U.S., Britain, and then Germany. And once Britain realizes, or once they start to say, okay, the Bank of England, Carney comes out and says, I'm going to start looking at possibly raising rates. He doesn't have to raise rates. All they got to do is hint at it, and then the pound is going to start a long journey to the upside. Okay, and that's what we're going to watch for on the pound. The euro, no. We're bearish the euro. Even though we've got a bullish divergence here, I think this has got further downside to go. Why? Well, guess what happens? If Draghi comes out and says, hey, we're going to pump we're going to start buying government bonds. We're going to start forcing interest rates even lower, if you can believe that. And then you're going to see the euro come here all the way down to here. In fact, that's my projection for the euro. Even though we've got a bullish divergence down here, remember, it takes a while. We don't have the trigger for a long signal yet. And we're down in this shaded zone right here, which has been a support zone for the euro. We've just been tracking. It kind of looks like the British pound. We can't get over the 50 EMA, which is sitting right there. I think this thing has got further to go. You can see this channel. It's going to do one of those kind of things with these counter trend rallies, which is for those that aren't in it, you use them to either add to your position or get into your position. For you members, I think we went into a lot of detail on how to do that, but this is where I see the euro going. So you can play it. You can go short FXE. Right, that is a good play with an ETF, or you could play the futures market, or you can do the Forex, and you can be long the U.S. dollar, short the euro, right? You can do that. That would be one combination you can do. I like the futures market. That's the purest form of trade. But anyway, pick your poison. But that would be what I like longer term with the euro. Because if Draghi does that, by the way, that's also going to be bullish the dollar. All right, it's going to have a contra effect of being bullish the dollar. The yen, bearish. Remember what we said about the yen. Let me get the yen up here. It had a counter-cyclical move, and I got our members set for this. Remember what I told you guys, especially all of you members in this session. I said this is going to be an opportunity to get back into the yen. For those of you that missed the trade, you can see right there the yen. This is a daily chart. I said trade the breakout. Whichever way it breaks, I don't care. I said I favor a downside break. It broke to the downside, and then we had a couple of breaks here, but you got chopped out of it. But right here was the final one that finally gave up. Boom. And every counter trend move in the yen has been met by sellers. And I said these counter trend moves is where you want to come in and make a short trade. All right? So, and we favor this to the downside. So you can see there's one right there. So that's an entry point right there. Here's another one right there. We just got the entry point late last week. And you can see right there, it's absolutely, there is no bullish divergence there. So we can go a lot lower. Again, you can play the futures market. You can play FXY, which is the kind of the ETF equivalent of this. You can play that one, or you can play the dollar-yen, right? The dollar-yen pair in the Forex. I don't care how you play it. I like the futures because it's the purest form. There was an entry right there, there was an entry right there, and there was an entry right there. So we had 1, 2, 3. And for our members that are in it, and I know we've got some that are still in it now here, it's a home run. In the futures market, that's over $20,000 per contract. But even with FXY, you're probably doing very well. All right, so it's just a great, great trade. So congrats to our members that are on that trade. It's a good one. Currencies are going to be fun next year, guys. Currencies are fun as long as the governments get in and start mucking up everything, because the currencies trend, as you guys can see. These suckers trend. So these are some that I like. Now, if we come on down, take a look at a couple of other things here. Let's go into metals. Gold. I know we've talked about gold before. To me, it is just slowly working its way back down. We've had this little counter trend move. You can see right here, but it's working its way back down. I would be more bearish gold than bullish gold. We've been bearish gold for 2014. You can see the wide channel here. But this to me is going to continue down, probably take out 1130. Why? Because there's no inflation. Now, I think gold, once inflation starts to kick in, we'll start to see it. When all of a sudden, not only is the U.S. raising interest rates, but we're going to see Europe start to raise interest rates. We're going to see Britain. Remember, the U.S. will probably lead the way first, then Britain, then probably the ECB in 2016. You're going to start to see gold start to move higher. Right now, it's a downside action. Silver, probably the same thing. You can see right here with silver. Now, I have said to a lot of our members that, longer term, I think silver is going to work its way back north again. So SLV is the ETF that you could play. Near term, though, I think it could find a lower low, below 15. But I don't have any problem if someone wants to play this 2 or 3 years out, just coming in. But I think you can get a better price if you wait. I think that's going to go down. Here's one that we haven't talked about in a while, the market vectors, gold miners. You can see these guys, it's just like gold. It's really down. But I do believe this is going to be another one that is going to move up when gold starts to move up. Right now, the projection of gold miners is to move down even lower than it is right now. We got a 3-4 pattern. I think the 5 is going to print down here. If we get this, now this is what I would like to see before I decide to play this guy, but I think we could get it. If we get this 3-leg, a 4-leg, and then a 5-leg down in this area here, let's come down. I'd love to see it take out 1584. We'll probably have one of these kind of things like that, and then that would give us a really good bullish divergence. Then I'll come in and I'll start deploying options down at this point down here. Probably ratio diagonals is a great way to do that. For those of you that are on this that don't understand options, then you should probably check out some of our educational videos. They'll be helpful for you. But ratio diagonal would probably be the best way to play this, because you can get not only directional bias, but you can get premium decay as well. So you kind of combine both of those. So that's a little bit about metals. Energy, well, energy is just, let's just say it's kind of defied a lot of odds. This reminds me of 2008 when I was short energy in 2008. You can see all my trend lines on here, or price levels on here. I think energy is going to do one of these numbers. That's why you guys have to be very careful. I do not. In fact, I like playing energy to the upside right now, believe it or not. But I recognize it's going to be a very short-term trade. It's just more of a a trade where we're going to trade one of these moves like this. We get a 4-leg print there, and then we come down and we get a final 5 down in that area there. That's what I would see is the most likely scenario as I see this right now. So yes, I think we're going to get a little bit of an up move here. It's going to sucker some people in. Also, that up move it'll trigger some buy stops because there's a ton of shorts in oil right now, and then we're going to get another rollover. So at this point right here, for those that sat on the sidelines watching energy go down, just like the yen, that would be an opportunity for another long. All right, that would be the way I would see oil at this point in time right now. Okay, for you members, in our chat room, I'll point it out to you as it starts to unfold. Gasoline, same thing. The nice thing about gas, again, we do not have bullish divergence in gas, but we're coming down to. Let me just go out to a weekly so you guys can see just the damage that's been done to gasoline. You can see right here, this is gasoline futures. You can see where we're sitting right now. Can we go lower? Sure. I think we will go lower. I think we're going to have a bounce just like oil, right? And what I think, and again, this is just what I think doesn't matter. It's just kind of what actually happens. But just looking at the charts, I think we'll probably get a roll up into that area right there. We'll probably have a final capitulation somewhere down in that area there. And then probably around the March, April time frame, of 2015, as we start to run into the spring, gas is going to be in its normal cyclical bullish self, and it's going to start to make huge runs to the upside. So that would be kind of how I would see gasoline playing. This is how I would kind of see oil playing. So that would be what I would see there. Yeah, Blake, let me go back to the oil chart and show you. This is a weekly chart of gasoline, okay? But let me just go back to oil and show you that chart there. I think oil is going to track the same with gasoline. They're both cyclical in nature as well, although the correlation is not 100%. Here is the daily. If you look at the weekly of oil, you're going to see here, we had this break. Now, guys, for our members, this was a known trade right here for us. I know some of you took it and made a good amount of money, which I'm glad you guys took the trade. But we had the situation here where it was a 50% break. So we could have broke to the upside, or we could have broke 50% of the odds favored a downside break. We had a clear break there, so I called a short in oil. I said the measuring objective was right there at the 50 level. That was the measuring objective of the move. Now, I didn't realize we would make it almost that fast because we came down to 52. But I do believe we're going to get one of these kind of moves and then a roll back down, a final thrust. We could even come down. I don't think we're going to come down to this one. This was the low we made in 2008. I think the dynamics of the market are different than they are now. So we're going to get a little bit of a contra move up, a little bit of a roll, and then boom, away we go, okay? But this is a weekly chart, Blake, on this one. So notice on the weekly chart, we got the 3-leg there. Then I think we're going to get a 4-leg and then a 5-leg, right? So this is just a hard break. I think most of the first quarter and the second quarter of 2016 are going to be very interesting. I do believe the near term for oil is going to be up, but again, it's a contra move. All right, that's all I see it as right now, is a contra move. I see absolutely no bullish divergences in this at all. All right. Now, Blake, as a member, I would suggest you go in and take a look at our how we run our smaller time frames for buy on the dip, sell in the rally kind of mode. Okay, and we're going to convert over to that. But that would be the way I would play this. Natural gas, this is the widowmaker, as some of our members like to call it. You can see here on a daily chart, it's just come unglued, really come unglued right here, right? You can see, boom, we took out that key low right there, and we're in the process of forming a 5 down, and we can go down lower, right? I mean, we can go down much lower. So I think the near-term move of natural gas is to the downside. And if I were to, let's just step it out to a weekly here for a second. You can see we followed this range, this trend line range. We broke it. We could not penetrate it, and then boom, away we go. So the next level down that I see that makes sense to me is right in that area there, right around 319. Okay, that's where I see us heading. And that gives us a 5-leg down. I do not believe we're going to come back down to this low down here. I don't see that. But I do see an interim move here. So for those that are UNG or natural gas, I would see it coming down to this area down here, 319. That would be how I'd see natural gas play. Agriculture, well, you know, we played wheat. We made good money in wheat. Wheat had a bad down day on Friday, but there is no bearish divergence in wheat. You can see the performance of wheat as one of the ags. We played this bullish. It was a bullish play for us. We had a lot of fun in this. This is a daily chart. We zoom in. What this is telling me on this daily chart, we'll probably get this 3, 4, 5 pattern again. So for those that aren't in wheat or in trade commodities, then what I'm going to be looking for is, I already got out, but I've taken some profits, a pullback, you know, give us one of these kind of things, and then a final thrust higher here. We have absolutely no bearish divergence at all, so this just tells me this is just a profit-taking leg. That's all it is. Okay, so that would be wheat. I'm not going to go into some of the other ags, but they look similar. All right, they're fairly strong right now. So that would be looking at the agricultural marketplace right now. Meats. For those that were with me on the meats and live cattle, we had a lot of fun in this guy right here. Remember, you could trade moo or cow, but it doesn't really follow like the futures. We had a beautiful signal in meats, and we took it up in this point right here. Made great money on it. And Randy, I know you're kicking yourself. It's kind of like the way I kicked myself with the yen trade because I was on vacation when the initial break hit. But this one right here gave us good profits. We jumped in right there, rode it all the way down. I got out right in that area there. So it was a great futures trade. I think we're going to get one of these kind of moves, possibly up to 1.63, maybe a little bit higher. We'll get a 4-leg print, and then it's going to roll over, come back down to that area there. If it breaks, it's a key support area. We're going to come down to this zone right there, giving us that Elliott Wave 5 down in that area here. So I'm looking for a break. I'm waiting for the setup, and then I want to jump in. So it'll give us a setup. The highest probability move was right up there. We've already taken that and cashed in for profits. Okay, we had a couple of limit down day moves on this, which was really cool. And for those members that are new to commodities that were actually able to jump in, you got an opportunity to see what happens. Yeah, WEAT. Blake asked the question, is there an ETF that mirrors wheat? WEAT. Here's the ETF right here. But the liquidity is not as good as I would like. It looks just like wheat, WEAT. But you could trade the stock. It's only $13 a share, so you could pick up 500 shares. Remember, when we got into the trade, it was down around 11 on the future in this ETF. I got in around that range, so you could have picked it up at 11, and then now it's sitting at 13.53. So, you know, it's a nice trade to take. But right now, it's on a pullback mode. I would not go long. I'd wait for an entry. Okay, couple of other things out there that I want to go through. For those of you that took our trade in Tesla, we did really well, and we've had a hard bounce up. I am still, believe it or not, bearish Tesla. I'm not in the trade now, but we had a head and shoulders pattern. We had a break. We came all the way down. I was calling it down a little bit lower than 178, around the 150 area. It's had a huge run up. What I see happening with Tesla right now, there is no bullish divergence in this guy. What I see happening and what I want to watch for, remember the markets, when Janet Yellen did her thing, everything, just pretty much everything, good and bad, went up. I see us coming up, challenging this neckline, and then rolling back over. Notice that's a 3-leg. That would give us a 4-leg, and then a 5-leg down there, which would carry us down to kind of an original projection that I had talked about. Okay, so that's kind of what I'm seeing right now. Notice we got the 50 EMA that's on a downward vector right now. I think that's going to hold us up a little bit. And then if it starts to roll, then you can jump back in again for those that got washed out. I also suggested to my members to take some profits off the table. Remember, when you've got a Fed meeting or an FOMC meeting, I don't care what the charts say, they can change the course of any pattern just by saying, be patient. And the markets go crazy. Yeah, it's just, oh my goodness, it's crazy. But you got to just respect them. You got to respect. You can't fight the Fed. I'm sure you guys have heard that saying before. The other one that we took, which I think was a pig, I like the product, right? I love the product. But I just think it just imploded. And the pattern was very similar to the pattern that we got in oil. Right here, here's GoPro. I called it out to our members. I know a lot of you guys jumped in on it. Some of you missed the trade. That's all right. But, again, with this kind of pattern, you got a 50% probability of an upside break. You got a 50% probability of a downside break. Now, I felt it would break down, but at the end of the day, you trade the break. We got in right there, and, this was my I think I'm calling for a target right in that area there, and it's just been ugly. In fact, over the past 2 days when the market has been going strong, huge sell-off right there. It tried to move up, and then it just gave it all back up again. So I think this thing's got further to go. But for those that aren't in it, I wouldn't chase it down at this level. You guys know how to sell a rally. I went through a lot of detail on how to sell a rally using different time elements to enter your trade. But that was the break right there. That was the trade that we took. All right. So that's GoPro. So let's just move out here like this. Okay. Now, if we come back over here, well, how did this thing work here? Okay, good. So if we come back over here, and these were just a couple there were other trades out there, obviously, but I'm just kind of highlighting some of the ones that we really liked. Guys, I did, and as I told you guys, I did take an entry in Apple, all right? And this was, I just recently took it, and I'll tell you why. There's a little bit of a risk in the trade. You can see the movement is down, but what I did, and the reason why I did it, and I did a ratio diagonal on this one. I think I called it out to you guys when I took the trade. We got a 3-leg, a 4-leg, a potential 5-leg. The target that I'm seeing here is around 122. Okay, you can see right there we had a little bit of a sell-off, but it was not. This was more profit taking than anything else. We had a break to the upside, which is a bullish thing, and I think we're going to come up and have one of these kind of things like this, and it'll look kind of like that. And then we're going to hit this level here, and that's going to give us another bed, bearish divergence, right? And then I'm going to flip over from longs to shorts, and then I'm going to play it back down again because we're going to have that. But right now, I'm playing a move like this. Now, earnings are coming out in January. Apple's earnings are going to come out. I think Apple, because of this big sell-off right there, I think they're going to report very strong earnings for Christmas. I'm seeing a lot of the reports that I'm seeing is just going to be an outstanding Christmas and a pretty good forecast for 2015. So because of this sell-off right here, I think this thing is going to just go through the roof. So I'm going to play this up into earnings, and then I'll take a lot of my profits, and I'll probably take a spec trade into earnings, thinking it'll go way up in this area up here. But I'm going to take a lot of my profits off right before earnings because I think Apple is going to run up into earnings. I've seen it happen with Apple many times. And typically, it's common to see that with Apple. Now, it's a riskier trade, but I do like the trade in Apple along those lines. So that was just another one that I took. Okay. Let me just see if there's any other ones that come to mind for me. No, I'm not doing any of the countries right now. That's kind of how that one's playing out. All right, guys. So just as a reminder here, for those of you that are non-members on our session, love to have you come on in. We're taking some great trades. I think 2016 is going to be even better. I'm sorry, 2016. I really want to jump ahead, don't I? 2015 is going to be great. We're going to see some volatility spikes. I'm going to go into, we've got a new webinar session coming up on position management and trade adjustment. I was going to start it in December, but I think I'm going to start it in January now. I'm traveling in Europe right now, so I think that's going to happen starting in January. If you're a member, it's free to attend. If not, that session will be $199. You'll see the invite come out to it shortly, or the sign-up process. But all of our videos and everything are free if you're a member. We've done very well in 2014, and I think 2015 I think currencies is going to be a lot of fun for us in 2015. Interest rates as well. So everybody have a really great remainder of the weekend. For our members, I will see you Tuesday morning. We will not do a Sunday night session. This will be recorded and put out to the blog for everybody. Have a good one, everybody. If you have any questions or anything, just go to our website, click on Contact Us, click on it, and I'll be in touch with you. All right. Have a good weekend, everybody, and happy holidays. Bye.